Jim Crowley then asked, are we in a deal bubble? And Kurt and Dave's reaction was no, we're not at this point. Rush, on the other hand, felt that although generally we're not, on the smaller, medium-sized deals, maybe not, his comment was at the high end, it feels bubbly. So that, at the high end of the deal, maybe we're getting on the edge of, we're starting to get into a bubble. It's starting to get bubbly.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. Today is a solo cast, and on today's solo cast, I'm going to be talking about some of the learnings that I jotted down from a phenomenal event that I spoke at a couple of weeks ago that was hosted by Echelon Partners, one of the investment bankers in the investment advisory space. And every year they do their Deal and Dealmakers Summit. And I've been fortunate to speak there, I think, at least 3 times over the years. So I wanted to, they had a phenomenal lineup of people and who were on the speakers and on the panels, et cetera, and some great information from Echelon itself on deals in the investment advisory space. And I wanted to do a recap of that. The event started out with a experts session. Basically, Dan Sievert, who runs Echelon, had 30 some odd experts, including me. I was fortunate enough to be one of the experts, and there were 4 half-hour sessions where participants in the conference got to sit down with an expert and basically get a half hour of their time, and ask any question they wanted and that kind of stuff. And I think that's a brilliant format that a lot of some of the conferences are starting to do now, and it gives the audience access to some of the speakers. Like me, some of the other experts were not speaking at this particular event, but they were still there. And frankly, it gets people some free time with an expert. So it's a big value add for for a conference if you happen to be, running one and putting it on. It's certainly something to think about that I think, makes some sense because people always find value from that. So, I got to meet with 4 folks and, give them some information, build some new relationships. Actually, one of the people was somebody I had met at a prior event and had some specific stuff and is now, become a client. So it's generated some business already, which is phenomenal. So that was the first evening, starting around 4:00. There was a dinner after that, and then there was a full day session the next day, and that's really what I'm going to talk about in terms of the content. So the event started out the next day with a session called Buyers of the Roundtable, and that session was hosted by Jim Crowley, who's the CEO of BNY Mellon Pershing. And then he had on the panel Rush Benton from CapTrust, Dave Welling, the CEO of Mercer Advisors, and then Kurt Masinski, President and CEO of Cerity Partners. So some of the things they talked about is that the cost of money is low right now. I think we all know that. Frankly, across industries, certainly in the RIA space, there's a lot of capital available, and it's pretty reasonable. The trend is that deals continue to grow. Meaning that, the deal volume and size continue to grow. So there's about $230 trillion in deal volume in 2018. Kurt talked about one of the biggest challenges being evaluating cultural fit, which is crucial because there's a need not only for the principals to buy in, but to then advocate to their team. And one of the quotes he said, which I like, was, "Culture cannot be acquired or mandated. It must be embraced." So, the way I look at that is, too often what happens is the execs are involved with the negotiations and putting the deal together, and then they sort of spring it on the rest of their team down the line later. And this is true in any industry. And then, it's sort of a forced integration of the target, or if you are the target, into the buyer. And people aren't prepared, and they have problems with integrating and that kind of stuff. And we've had some guests on the show, on the podcast, on prior episodes that have talked about integration of people and how you do that well. And Kurt was certainly pointing out that that's something that's got to be done, and basically you need buy-in. You need the team to embrace it. You can't impose it on them. So Dave then talked about some seller challenges, which is meaning why people sell and what selling to a bigger place solves for. And this is, Mercer's been doing a number of acquisitions to solve for these things. And he talked about new client growth, that with a lot of firms that has slowed, they don't or stalled. So they're trying to solve for that. Time management, efficiency, productivity, and scale. They get to a point where they have trouble, managing everything that's going on, and being productive, managing their time, and being able to scale at the same time. And they need some resources and support for that. Talent, the ability, to hire, attract talent, develop talent, train talent, and making the tech investments and realizing the value from that talent. That's something that some firms have trouble with. And, those were all the reasons why he talked about it may make sense for firms to combine with, sell to, join a larger firm that has some of that capacity in place and can support the seller to grow, to manage time, better, and to have be able to attract talent. Rush then talked about some of the buyer's challenges. Those included the fact that it is, in his view, a seller. It was interesting because later in the conference, Dan Sievert did some significant analysis, or Echelon had done analysis that Dan shared, and he questioned the idea of it being a seller's market. I mean, that seems to be the theme. That's frankly my impression, and certainly in terms of numbers. But he talked about, later in the conference, more about how valuations are and terms are, and how he feels that sellers are actually leaving money on the table, that they that they do have some leverage there. So while some may feel it's a seller's market, at least Dan seems to feel that sellers aren't fully taking advantage of that. And Rush also mentioned something that I'm concerned with, that there are a lot of funded buyers within patient capital who are overpaying for deals. And I've seen that, listen, I've been practicing for law for over 35 or almost 35 years in various industries. And, you certainly see cycles where more and more money comes into an industry. And then you lose, firms lose deal discipline, or there's more competition and valuations go up. And then there's a downturn, where people have overpaid and they run into trouble. You see this in real estate, for example, all the time. And you've seen it in various other industries. I saw it in tech recruiting some years back, where there were a lot of deals in that industry. And certainly there is some who feel that's starting to happen in the RIA space. So Jim Crowley then asked, are we in a deal bubble? And Kurt and Dave's reaction was no, we're not at this point. Rush, on the other hand, felt that although generally we're not, on the smaller, medium-sized deals, maybe not, his comment was, at the high end, it feels bubbly. So that, at the high end of the deal, maybe we're getting on the edge of, we're starting to get into a bubble. It's starting to get bubbly. So that's an interesting viewpoint, and it'll be interesting to hear what you think. Feel free to put some stuff forth in the comments. I'd love to hear your views on where you think we are in the cycle of the RIA market in terms of, bubble, no bubble, overpaying, sellers market, buyers market. What do you think's going on? Okay, the next session after the little break was, before the break actually was a keynote debate. So this is a sort of a staple of the Deal and Dealmaker Summit that I'm trying to remember if Dan's done it every year. I think he may have. He's certainly done it every year that I've been there. where he and Mark Tabergian from Pershing. So Mark's the CEO and managing director of Advisor Solutions at BNY Mellon Pershing, and Dan Sievert, of course, is the CEO of Echelon Partners. And they do this keynote debate format every year. This time it was moderated by Megan Carpenter, who's the CEO of FICOM Partners, one of the PR and marketing firms in the space. And they what they do every year is they take certain topics, and in this case they did 7 different topics. And they each take a side, and it's drawn by lots. So they're making an argument that they don't necessarily, they may agree with it, they may not. It's just for the purposes of the debate. And there's a voting from the audience on who they think won the debate. And, so it's kind of a fun format, and it seems to work every year. And then afterwards, if there's time, and there was time on 5 of the 7, they had an opportunity to say what their real views were, because, again, they may be taking the side of something that's not their real view. So in that case, the topics this year were the ideal way to grow. So is it recruiting or acquiring? And they went back and forth on that. At the end, the real view, it was interesting. Dan, who of course is an investment banker, who you would think would lean towards deals, actually said that he advises clients to recruit first. Grow through recruiting to try to get bigger, so you're more in a position to do deals and then do acquisitions. Mark talked about another strategy, which is acquiring to get a foothold, like in a new geographic market, and then using that as a hub to recruit people thereafter. So, those are 2 approaches, not necessarily mutually exclusive, and that's interesting. The next topic was who owns the client, and the firm or the advisor. So, in other words, how do you set that up? And the bottom line advice, from Dan, was, listen, the biggest thing you can do to keep advisors with you is to do a great job keeping them happy. Right? That's the most effective thing. And then, they don't need to leave and solicit clients because they want to stay, and you've got a great platform and they're happy and you're providing great service to them. But he also recommends, strong legal agreements in place to protect your interests, and Mark agreed with that. The next question was, can high margin firms, which are firms that are making, let's say, 35% margin or more, sustain their advantage? Mark is very concerned that the average industry firm is not growing assets quickly enough. Regulatory pressure is increasing transparency requirements and reducing margins. Operating expenses, for good firms are at 30 to 35%, but many have higher. Dan pointed out that automation and AI and some of these new technologies can help increase margins with the same pricing, and that firms are going to have to do that. And Mark didn't necessarily disagree, but he did point out that he feels actually that there's an over-investment in technology. And he was saying that, interestingly, not to discourage investment in technology, but his key point was it's over invested in but underutilized. So it's, the technology investment is one thing, but the utilization of that technology is really what counts. So he feels that firms should not necessarily just increase their dollar amount, but make sure that what they the new technology they invest in is utilized, or first start utilizing their existing investment in technology in a way that gets the most value out of it. There was then a discussion. The 4th topic was on sharing synergy value and how it's split. And listen, frankly, the bottom line, I think, conclusion on that is it's tough to calculate and tough to, it's subject to negotiation. What that means is, hey, if 1 + 1 is going to equal 3 in some sort of combination, all right, you can easily value the 1 and the 1, but then the extra 1 that's created, the synergy value, who gets the benefit of that? Buyer, seller, and how is that split? So that's always an interesting topic to talk about. The 5th topic was raising equity, good or bad. And Mark's big points on that were that the equity, that the type of money you raise needs to match the useful life of the asset. Okay, and the cost of debt is so cheap these days. That's the other thing he talked about. But the first thing is, right, match it to the asset. Right, don't borrow money for something that you're paying back for a longer term than the asset is going to be worth to you. The second one is with the cost of debt being cheap, he actually there's been a lot of criticism in the press with particularly Focus Financial, going over 4 times EBITDA debt ratio. And Mark sort of questioned whether that's a problem. He said the cost of debt's so cheap these days, not so sure that the criticism is valid. So the debt ratio may not be as much of an issue. Dan did point out, and Dan obviously comes from a world where he's done a lot of analysis and has experience in this stuff, that history tells us that more than 4 times EBITDA is a problem. So he had some concerns about that. Mark said the key is to look at the impact on cash flow. So really, how does that affect cash flow? Which is why when interest rates are low on the debt, it's less of a concern, right? Because you could have the same amount of debt, but the cost of capital is lower. Dan talked about the need to match the need, with the investing partners. So in other words, equity capital can bring other benefits, expertise, relationships, things like that. And what you want to do is not just look at the money, but make sure that you're, look at what else you're getting out of that relationship. And Mark's final point sort of relates to his first point about matching the asset to the useful life is don't use debt for a depreciating asset. The final 2 topics, which we had less time to hear their real views on, were the benefits of joining a multidisciplinary wealth management, being the key to surviving. Like, is that the way the industry's going? And it's key that you do that, or can you stay independent in one niche? And they sort of went back and forth on that. And I think that's an interesting topic. I mean, I think, listen, what you find in most consolidating industries, you've seen this in the accounting world. You've seen this in a lot of other places where, there is definitely consolidation. Things come together. That's a maturing industry, and which means that the firms will be bigger and more multidisciplinary. But then there's also always room in the industry for smaller firms. I think what happens sometimes in various industries, the middle starts going away. Things either stay really niche, smaller, or they get much bigger, and it's hard to be somewhere in the middle. That's been the experience I've seen in other industries. And then finally, how wealth managers will fare as public companies, which is an interesting question, right? There's only been a couple, a few that have gone out. Focus obviously has been one of them. And it's an interesting question to see how that will go, in the future. The next panel after the break was working with private equity investors, which was moderated by Carolyn Armitage, who is a managing director at Echelon. And the panel on that one was Jeff Decco, who's the CEO of Wealth Enhancement Group, Jim Gold, who is the CEO of Stewart Partners Global Advisory, and Larry Roth, who's the managing partner at RLR Strategic Partners. The first thing, Carolyn presented some Echelon proprietary research on a number of things. The one thing that was interesting to me, one of the things that was interesting to me, was that PE investors were involved in 61% of deals above $1 billion. And that sort of makes sense, right? Obviously, the bigger deals are more likely to be funded deals. But it was interesting. It's been, I forgot what time period that was. I think it might have been 2018. That was 61%. Jim Gold of Stewart was talking about PE firms bringing, basically more resources than individual and family offices, meaning individual investors and family offices, but they also require more control provisions. So, in that decision on do you take private equity or do you raise angel or do you, raise family office money, that's the trade-off, all right? There's more resources, more capacity in PE firms, but they take more control. And, and he talks about, listen, before the bear market comes, we don't know when that is, but it's going to be coming. It always does. And capital dries up, capital's cheap now, maybe a good time to get some money in place for the things that you want to do in the future. Jeff Decco of Wealth Enhancement made a point on due diligence, which is interesting. It's something I talk to clients about, but not every one of them decides to do it, which is he says that on his deals, he actually has his attorney review every client agreement. Now, why do I say it that way? Because many times the seller will say, "Oh, we have 1 or 2 forms of client agreements. We'll send you the form, and then that's what we use for everybody." And they just review the form. Jeff's point was, listen, you got to have an attorney review every single agreement. And listen, that could be hundreds or thousands in some of these cases, depending upon how many households, how many accounts there are. But his reasoning is that There are often exceptions, changes to the form, modifications. People say they have 2 form agreements, but you find out that they have 12. Or 4, but then eight more that have exceptions, and it's important to see what you're buying. He also, they immediately move clients to make sure there's negative consent going forward, even if there wasn't in the past, and to digital delivery in their new agreements with clients. He thinks that's important, and I think those things make sense as well. Larry Roth of RLR Strategic Partners talked about, the freedom that management has, or lack thereof, in terms of choosing to do deals when you have private equity investment. And what he says is that generally what he's seen is, in his experience, because these are funded companies on this panel, that the management does have discretion to choose the kind of deals, the targets that they're acquiring, but that discretion is within a very narrow range of parameters that have been set with the PE firm or by the PE firm. So they'll say, hey, we're only going to look for these type of this size deal, this evaluation, this kind of stuff. So they'll set the parameters, and then within those parameters, management, they generally trust management to make decisions, but not. But you don't have the freedom to go outside those parameters. The other thing, of course, he pointed out is that PE firms are looking for quicker returns. So, they're looking to be out 4 to 6 years in theory or less if possible. They'll usually be starting to pressure you around the 3-year time period to find a way for them to exit and make a return on their capital. So you got to keep that in mind when you're raising capital. So that was an interesting session, and what I like about the people that Echelon had is that these are people who are not talking from theory. They have all experienced the things that they're talking about in terms of deals, in terms of private equity investment, that kind of stuff. The next panel was on recruiting and breakaway deals. Which was interesting. That one was moderated by Bill Van Law, who's the CEO of WVL Group. And the featured speakers on that one, the panel, were Bill Willis, CEO of Willis Consulting, Jeff Bischoff, CEO of Old Greenwich Consultants, and Rob Baldwin, President and CEO of Trade PMR. So on that panel, there was discussion of the primary driver, what are the primary drivers for advisors choosing to break away. And Bill Willis talked about, in his view, the primary driver is the lack of control that an advisor has in the wirehouse environment, for example. And he talked about, including to want to control their succession. That's a big thing. And the wirehouse succession plans, the sunset deals, as they often call them, are very rigid. There's not a lot of options to structure them in different ways. You get sort of locked into them. And, he also talked about how bad press has tarnished some of those brands as well, making them less attractive to stay at the wirehouse. And then talking about, when there's a downturn, that it won't be as easy to make money, and so things will change. And, if you're locked into, you don't have flexibility, you're locked into a succession plan, when things change, that may not be the best for you. And, the other thing that was interesting to him in terms of how things have evolved is that it used to be, with the advisors that he would talk to 10 years ago, maybe 10% of them asked about RIA independence as an option. They were more looking to go to another wirehouse or maybe to an IBD, whereas now 80% of advisors ask him about RIA independence. So, that tracks the evolution of the RIA independence movement over the last 10 plus years. Jeff Bischoff of Old Greenwich Consulting talked about how, with the bull run, market run over the last, 10 years, many senior advisors have hit their number already, meaning, whatever their number is they need for, retirement, where they're set, they've hit it, and they don't need additional money. So they're fine. What he talked about, the vulnerable people, though, are the next gen advisors, right? The ones who are, the next gen down for that, because once they sign a wirehouse sunset deal, both sides are locked in. Now, if the market goes down, et cetera, again, the senior people they're good either way. I mean, obviously they want more money, but they've hit their number already, whereas the junior folks are the ones who can get hurt. So, they're the ones who are looking at more options and possibly not getting locked into these sunset deals and, going independent to build enterprise value. Rob Baldwin, Trade PMR, talked about the primary driver that he sees is freedom. The ability to market yourself as you want, control investment decisions, and also obviously have a greater monetary share. Because there are so many success stories now that you're not breaking ground to go to independence. People have seen firms do very, very, very well, so they see that there's an ability to make more money and have more freedom. One of the weaknesses, he says, in the industry, and I agree with this, is that they don't seek out the competition. So owners of RIA firms look at people as competition. They shouldn't share information and they shouldn't meet with them. But that's how you get better succession solutions. You build relationships with other people in the business, whether it's in your geography or doing what you do, et cetera. And there's a way to do that, where you build relationships and, they can potentially become merger partners, acquisition partners, succession solutions down the line. And, that's an underutilized opportunity, according to Rob. And again, I agree. All the panelists agreed that there's an inability to accommodate non-standard alts, is an issue that deters FAs from moving, meaning that they may have alternative investments that are non-standard at the wirehouse that are tougher to be accommodated from let's say a friendly broker dealer or an RA firm that's acquiring. So that's one deterrent that comes up sometimes, but there's still obviously the move is much more strongly towards moving to independence and the advantages of that. The next panel was called the people side of deal making. And that was moderated by Jeff Warren of Russell Reynolds. And really that was more of an interview because the only other person up there was Manny Roman, CEO of PIMCO. And it was really more Jeff interviewing Manny. And Manny talked about the need to have a shared vision and aligned incentives because you can never fully underwrite culture. There's always surprises. So in other words, in due diligence, upfront, et cetera, you like to think that everybody talks about you need cultural alignment, you can do your due diligence on that. But, his view is you can never guarantee it, you can never fully underwrite it, and you never can, analyze it fully until things come in. So you have to understand that, number one, then you also have to make sure there's a shared vision and then align incentives going forward to help the cultures come together. His view is that, he would rather pay for a healthy firm, even if it's more money, than get into a deal value trap and try to catch a falling knife. So, if a firm has revenues that are, they're dropping or AUM that is dropping and there's some issues there, and, some people may say, oh, there's an opportunity to get that cheaper. His view is that, there's probably more there than you know about. It's heading in the wrong direction. He'd rather pay more for a healthy firm. That's his view. One of the things he says is never do a deal because the numbers work, meaning that, that's the only thing. You got to look beyond that. You got to break bread. This is a people business. You got to get to know the folks. And certainly I agree with that. And I think anybody who really does deals in any industry would agree with that. He talks about the need to get investing, servicing, and social mission all in place. You can't just rely upon returns, which won't last forever. So, there are other factors in terms of the way you deal with clients and the philosophy of the firms and the culture that are important to get in place to maintain client relationships, as opposed to just, having the relationship be dependent upon good returns, because those will go away at some point. Okay, the next section was a section that Dan Sievert did on his own on deal structures, valuation, and transaction trends. And Dan talked about, that we're in the longest expansion in history, 4 times longer than the median, but the third slowest in terms of annual growth, so 3.9%. So it's way longer in years, but it's been slow growth, and I think we knew that generally, but the stats are interesting. He talked about an example of what would happen if the Dow went down 20% to a firm that is potentially looking to sell, let's say. So let's say the Dow went down 20%, and that more importantly that, let's say the assets under management for the firm dropped that same 20%, which obviously is not always the case, but that's the important part. So AUM drops 20%, which drops revenue. And he had specific assumptions on how much they charge and this kind of stuff, which I won't get into. But in his example, which is a pretty, fair example, Dow drops, AUM drops 20%, revenue drops 15% based upon that drop in AUM 20%. EBITDA then drops 60% and valuation drops 70%. Now, why is that important? And why does that happen? Right. So in other words, what he's saying is, listen, if you get a 20% drop in the market, you're not going to get a 20% drop in your valuation as an enterprise. If you want to sell, you're going to get a 70% drop. And the reason is because a 20% drop in AUM, which causes a 15% drop in revenue, you still have all of these kind of fixed expenses, right, that are involved, right? Whether it's rent or people or whatever. Now, you can make some adjustments, but without adjustments, EBIT is going to drop 60% because obviously your profit margins aren't 100%. So when revenue drops significantly and your cost basis doesn't drop at the same percentage because of your fixed costs, your EBIT is going to drop a lot more quickly. And then because valuations are often done on a multiple of EBITDA, you get a much higher valuation drop. So it's important to understand that. And what does that mean? Does it mean you should panic? No, not necessarily in my view. I mean, either, that you look at it and that may cause you to decide to do a deal now while the market's still good, or you need to understand that. And if the market's going to go down, you may have to wait a cycle, for it to go back up to get that valuation back. He talks about that there's been a net reduction of 5,000 advisors per year in the industry. So we're losing more than we're bringing into the industry, which is a potential problem over time. It also means the AUM per advisor is going up. Obviously, there are fewer advisors, but the AUM has actually increased because the market's been up. You're going to have much higher per advisor AUM. He talked about at what stage there's peak margins and going through the growth of a firm. So as a firm grows up to about $500 million in AUM, that seems to be where peak margins hit 40, 50, even approaching 60%. Because obviously when you move up from 100 million or less up to 500 million, you're creating some economies of scale. There are some, fundamental things, fixed costs that have to be in place no matter whether you're 100 million or 500 million. Then Dan says, after that, you hit something called the Valley of Doom and margins drop. And why is that? Because to get from 500 million roughly up to $1 billion, you need to hire and put in place additional management and have other expenses that you have not yet fully leveraged to start getting, the profit margins back up, right? You have to advance costs to go to that next level. So what happens is you take a decent hit in margins if you want to, in that move from 500 million to $1 billion in AUM. But of course, multiples go up as you grow. So you're increasing the enterprise value of the firm, but you're decreasing your cash flow for a period of time. The other thing he talked about is most private equity firms are looking for at least 3 million in EBITDA before they will invest. So that's, a target if you're looking to raise private equity money. You're looking at getting to 3 million in EBITDA above. And then so this is where I alluded to this before, where Dan said he does not believe it's a seller's market. He believes it's a mixed market. Valuations are still materially below historical highs. So Echelon's research has shown, if you look at history, that we are not at peak valuations. And he said under 200 million, valuations are very favorable for the seller. But in every segment above that, the valuations strongly favor the buyer. And this is where I alluded earlier what Dan was saying. He feels, and by the way, he said this on, we had him on the podcast. I don't have the episode number in front of me, but you can look it up. Dan was on the podcast, maybe about 6 weeks ago or 2 months ago. And that was something he said. I made the comment that, hey, do you agree that it's a seller's market? And his point was that that valuations aren't as high as they could be, and that sellers are leaving money on the table. Finally, not finally, but there were two other panels. The next one was actually the panel that I was on, and it was called Battle of the Outside Counsel. Advisors for buyers and sellers negotiate a purchase agreement live. And I got to tell you something. This was, Dan suggested this format, or told us he wanted us to do this format, and it was phenomenal. It was a blast. In fact, there was a big buzz after it. We got all kinds of good feedback. Dan told us it was one of the highest rated sessions, which my joke to him was, if you polled people in advance of the conference and asked which session would be, one of the best rated, how many people do you think would choose the session with the lawyers? But it was fun. So what we did was, it was myself, Ted Cohn, who's a partner at Cohn, Mainzer, Chris Frieden. Chris is a partner at Alston and Bird, and then Dave Mrazek, who's managing partner at Merchant Investment Management. So Dave's, in-house there and is a partner there, and not only in a legal capacity but also in a business capacity. And the funny part about this was, we had a prep call. I think it was 10 days or something before the conference. And then the next day, Dave and I were negotiating these exact issues on a real deal with merchants investing in a client of mine. And, Dave and I know each other since his focus days, and we've done a lot of deals over time. And the way they did it was really interesting. They had 4 issues that, that we talked about. It was the purchase price adjustment was the first one. And on that one, I took the seller's side, and Dave Mrazek took the buyer's side, and we had some fun there. And then there was ones on non-competes and reps and warranties and employment agreements. I was on the other side with Chris on the employment agreement side, where I on that one was on the buyer's side, and he was on the seller's side. So we each had one buyer's side and one seller's side, and we did at the beginning, the person on generally on the seller side would lay out the just quickly, what frame the topic and what the big concerns were. But then we'd get into an actual negotiation. We went back and forth, as opposed to just talking about it. We literally negotiated, and the audience loved it. It was a blast. We had a lot of fun doing it, I appreciate those guys. I think everybody did a great job, and it was, it went over well. The final session was on financing options for fueling deals, and I love that Dan used that term. Of course, having the Fueling Deals podcast and having him as a guest, I love that concept. So he had financing options for fueling deals, and that was a panel that was moderated by Mike Wonderly, who's one of the managing directors over at Echelon. And on the panel, they had Aaron Hessler, who's the managing partner at Skyview Partners, Ed Swenson, who's the COO at Dynasty Financial Partners, Dustin Mangione, who's the director at PPC Loan, and Rick Dennon, CEO of Oak Street Funding. And, they really talked about the capital availability, in the market, and specifically what their, various, products and who they focus on. And all of them, certainly, the 3, other than Dynasty, are either, lenders or brokers, of banks who are going to lend in the industry, and for things like acquisition, succession, formation, that kind of stuff. Obviously, the differentiator, or the difference, I should say, for Dynasty is that Dynasty has come up with a couple of financing solutions for firms on its platform. And they have this RPN note, which is a revenue participation note. In fact, I did one of the first RPNs that Dynasty did was with a team that I was representing. That's an ability for Dynasty to provide significant funding for, let's say, a breakaway team, and then they'll participate in a percentage of the revenue of the firm, on an ongoing basis, at least until there is an ability to buy out the note at some point if somebody wants to. So it's not equity and it's not debt. It's not true equity and it's not debt, but it's a contractual right to participate in revenue. And then, they also have a freedom note where it's more of a, traditional lending product that they do. And that's often with advisors who have notes, for example, at wirehouses and want to go independent and they need to pay off those notes. Dynasty provides that funding. So that was the final panel. Mark Bruno did a recap. Afterwards, Mark's managing director at Investment News, so he gave a recap. Then we had a great cocktail party and dinner, and got to network and meet each other and listen. The quality of the people, the quality of the connections, the phenomenal people that Dan and his team at Echelon bring in the room, were really great to spend some time with. Definitely, we'll be working with several of the people I met there. So, it's always phenomenal for me to make those kind of connections. And so I really appreciated being invited by Dan and Echelon to be both an expert and on a panel, but also, being in the room there and meeting folks and listening to the other great panelists. Definitely check it out. He does it every year on the West Coast. There was a point which I think he was another one on the East Coast, but I think he's keeping it on the West Coast these days. It's definitely worth going to next year and checking out what they have there. And then obviously Echelon is one of the premier investment banking firms in the space, doing buy side, sell side representation, valuations, consulting. So definitely check them out. And I excited to feature the Deal and Dealmakers Summit on this solo cast, and to have had Dan Sievert on an episode a couple months ago. Remember, there's only one difference between companies that grow inorganically and those that don't, and it's unrelated to size, amount of capital, or any other factor. Other than that, the owners and executives of companies that do deals make a decision to do deals, and then they take action. Well, it's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.